So, what on earth just happened to the markets? I mean, the last week has been an absolute roller coaster. We saw euphoria turn into sheer panic, seemingly in the blink of an eye, wiping out billions, and more importantly, signaling a massive shift in where the smart money is heading. So, what actually went down? Let's get into it. To really get this story, we have to start with the event that everyone is now calling the Friday meltdown. And look, this wasn't just a bad day at the office for the markets. This was a sudden, violent shock that caught almost everyone completely flat-footed. And right here, this is the epicenter of that shock. In just 24 hours, one day, a mind-boggling $19.1 billion was forcefully liquidated from the crypto market alone. And let's be clear, this wasn't just some investors deciding to cash out and take profits. No, this was a complete, forced wipeout of leveraged positions on a scale we have almost never seen before. Now, to put that number in perspective, because it's hard to wrap your head around, this single event was nearly 20 times larger than the infamous COVID crash back in March of 2020. Over 1.6 million individual traders had their accounts completely vaporized. This was, without a doubt, the single largest and most brutal liquidation event in the entire history of crypto. Okay, but here is where the story gets really, really fascinating. The pain wasn't felt everywhere. Not even close. While all the big tech darlings and the broader stock markets were absolutely bleeding out, something totally different was happening somewhere else. Capital was fleeing. It was running for the safety of real assets, with gold and silver just surging to new highs. You see, this wasn't just a crash. It was a rotation. So the big question is, what in the world could trigger such a dramatic and frankly divided reaction in the market? Well, the answer lies in the few hours before the meltdown. Because the market wasn't gripped by fear at all. It was the complete opposite. To understand what happened, we gotta rewind the tape. You have to understand, right before the floor fell out, the mood was pure euphoria. I mean, the sentiment was just overwhelmingly bullish. It really felt like the party was never going to end. The market wasn't just optimistic, it was on the absolute edge of its seat, just waiting for the next leg up. And you can see why, right? Bitcoin had just completely smashed through its old resistance levels, printing a fresh all-time high and trading comfortably above $126,000. I mean, from the outside looking in, it looked like there was nothing but clear blue sky ahead. And listen, this wasn't just retail investors getting caught up in the hype. No way. We had Wall Street giants like JP Morgan putting out these incredibly optimistic price targets that was basically fueling the fire and giving all the big institutions the green light to just pile in. The consensus was crystal clear. We were going higher. But here's the catch. Here's the crucial point. This entire mountain of optimism was built on an incredibly shaky foundation. More specifically, a foundation made of leverage. Open interest in Bitcoin futures had ballooned to a record high of over $94 billion. The entire system was a skyscraper of debt, more leverage than at any point in history, just waiting for a spark. And that spark? It was about to be provided by two powerful, interconnected triggers. One was a geopolitical headline that rattled the cage, and the other, well, the other was a much deeper economic shockwave that it helped unleash. In this timeline of events just shows you how quickly everything completely unraveled. You have this geopolitical chess match between the US and China that provided the initial rattle. But it was that second, decisive social media post, the one announcing a 100% tariff, that acted like an earthquake, hitting the market at a time of notoriously thin liquidity on a Friday afternoon. But while all the headlines were screaming about tariffs, the real damage was being caused by something economists call a liquidity shock. See, the tariff threat wasn't just about trade. It was a signal of a potential economic slowdown, which in turn completely shattered the market's most basic assumption, that cheap money would be available forever. Think of it this way. All those high-flying tech companies, they have these massive valuations because investors believe their future earnings are going to be huge. But the value of those future earnings is completely dependent on interest rates staying low. The second the expectation of cheap money evaporates, the math changes. The value of those future profits collapses almost instantly. For hypergrowth stocks, a liquidity shock like this is pure poison. And that shockwave didn't just cause a sell-off. No. It triggered a historic and, frankly, immediate rotation of capital. Money started moving with a speed that just showed a fundamental change in how investors were thinking. So where did all that money go? Well, it sprinted away from assets that depend on a perfect, rosy future, like hypergrowth tech, and it ran headfirst into assets that represent tangible, real value in the here and now. We're talking about real assets like gold and silver and domestic value stocks that are less exposed to all this global drama. It was a flight to safety, a flight to scarcity. Okay, so amidst all of this chaos, the crypto market, with its record-breaking leverage, was facing the ultimate trial by fire. This wasn't just another correction. This was a structural stress test of the entire asset class in a brand new macro environment. Remember all that leverage we talked about? The thing that fueled that euphoric rise? Well, it now became the market's absolute worst enemy. As prices started to drop, it triggered a massive domino effect of forced selling, creating this vicious downward spiral that just kept accelerating the crash. And in the absolute depths of the chaos, the price of Bitcoin just fell off a cliff. It flash crashed. On some exchanges, it hit lows around $14,500, a level that just wiped out months and months of gains in a matter of minutes. This was the moment that the over-leveraged system finally broke. But, and this is the most important part of the whole story, what happened next is what changes everything. This crash wasn't the end. Instead, you had huge institutions like BlackRock, who now have a massive stake in the game through their new ETFs, and they saw this as a colossal buying opportunity. They stepped right in to absorb the tidal waves of selling pressure. And the price didn't just bounce back a little. It snapped back with incredible force, quickly recovering to over $114,000. That rapid V-shaped recovery confirmed that there is now a strong institutional demand floor for Bitcoin, a safety net that simply did not exist in any previous market cycle. So the takeaway here is profound. Crypto survived a direct hit from a macro liquidity shock, a blow that honestly would have completely destroyed it in the past. It passed the stress test. It proved its resilience, and in doing so, it has fundamentally changed its own narrative. It is now being seen as a viable place for capital to run to when traditional assets are in turmoil. So as the dust finally settles on this absolutely chaotic week, what does it all mean for the market going forward? Well, it means the game has fundamentally changed. The rules are different now. Here's the bottom line. The old playbook that's worked for the last few years, you can pretty much just tear it up and throw it away. The core assumption of endless cheap money is gone. The market now hangs on every single geopolitical headline and Fed statement. And the major trend you have to watch now is this great rotation, this growing divergence between real assets valued for today and hyper-growth tech that's priced for perfect tomorrow. This event wasn't just a temporary crash. It wasn't just a blip on the radar. It was a reset. It was the market firing a massive signal flare into the sky, telling all of us that the rules of engagement have changed. And understanding this great rotation, well, that's now the single most important key to navigating whatever comes next.